In this video, we are going to look at a 1090 compared to a 2080, similar to the last video, like no other. We're going to look at a Guardian analysis in this video. And really, why this case study is like no other is this is not something that we put together originally, that is. I did put a lot of stuff together really to compare what was provided to us. But this is an IRR analysis where someone in the industry that does know their stuff put a claim out there that a 2080 design produces greater cash value long-term than a 1090, and provided illustrations with Guardian that proved it, specifically focusing on the 25-year mark and analyzing the internal rate of return. So anytime, again, I hear or see a claim like I want transparency, I want to see every detail there to know that people are not just making things up, because we've seen that so many times, or policies manipulated from a design standpoint, different products used, whatever it might be. Like, we want a fair, true, apples to apples comparison. The same thing I want to see when I'm considering a policy for myself. Like, that is so important to do. Like, imagine if you're a consumer and I tell you, hey, a 2080 is better, so I make double the amount of money, but then you find out I showed you a 2080 and I deliberately made the 1090 look worse to try and get the sale. Like, how are you going to feel when you eventually find out that you could have had a better policy or not everything was disclosed? Like, that kind of stuff goes on so much in the industry. Transparency is what's needed. So what we're going to start with is really this argument right here. What was shown, what we were presented with. So what we see here, beginning with a screenshot that was provided, is exactly this. So this is the full screenshot. This is the only thing that was provided in respect to the 1090 design. This is the 1090. We did not put this together. What product is this? Doesn't say. What's the base premium? Doesn't say. $50,000 per year going in. First year cash value, $43,000 and change. Breaking even between years 5 and 6. This is an age 40 male, preferred plus, best health class rating, all that good stuff. There's your internal rate of return, positive between years 5 and 6. Death benefits level, that has to do with Guardian's 1-year term rider. Now, quick side note as I scroll down here with Guardian's 1-year term rider. When that 1-year term rider is attached, Guardian will allow an agent, or allow one to illustrate 10x the base premium to be paid into PUAs per year with their traditional products, like an L99, like this example. Once that term rider falls off, the maximum PUA that they will allow is no longer 10x. So it's 10x with term, and then it is 3x without term. And here's how you can see it. So for the 25-year funding period, the payment eventually dropped to $20,000. And it is maxed out trying to fund $50K per year as long as possible for 25 years up until age 65. And the internal rate of return here is 3.54%. So considering everything and looking at this policy, everything was done to try and maximize the 1090 design with the Guardian L99 product that this was. And I'll show you that it's the L99 in a second. Let's progress on to the 2080 design. So a 2080 would mean what? If you're paying in $50,000, what percentage would go toward the base premium with a 2080? Be 10K, and the rest would be going toward PUAs. There's a term rider attached as well. Here's the 50K. Here's your first year cash value. So base premium dollars with a traditional product like the L99 that we looked at in the 1090 that was presented. This is by another company here, and comparing these two side by side, what do we notice? Well, that's a bit higher, right? With the L99, nothing shows up in cash value in the first and second year, or very, very little. Here, you're paying 50, you've got almost 42,000. Also, with this 2080 design, We're breaking even just about year 5, which is not characteristic of a 20/80 split. So I'm looking at this. This isn't Guardian's illustration software or their ledger. I'm looking at it and saying, okay, this is not an apples to apples comparison. That's my first just reaction when I'm looking at it, like, oh, come on, man. And then we see this, the death benefit, 2.915. So again, the whole purpose of this video is if you are a consumer, potential policyholder, trying to make sure you get things set up properly because you're interested in whole life insurance for maximum cash value, whatever it might be, what to look for, how to identify this kind of stuff. Transparency is important. Death benefit with a 20/80 should be higher with Guardian if the products are exactly the same. Payments drop off earlier, year 17 to 18 here. Not to $20K, but just to the base premium of $10,000. Internal rate of return, however, is higher. So from the case study, this supported the individual's argument that a 20/80 produced greater long-term cash value performance than a 10/90. Is it true? So my question would be, just knowing the products in and out, I'm not saying that to brag or anything like that, just you do something long enough, you can look at it and identify what product it is. Going back to the first screenshot, so we don't see any of the details here. My question would be, where's the money going? So what we did was duplicate the illustration. Here we go. Same out-of-pocket going in, $50K per year, breaking even between years 5 and 6, net cash value. This is the exact same internal rate of return report. Let me scroll down to year 25. 3.54%. Cash value, 1757. Let's go back to the screenshot just to validate this. Is everything accurate? 1757, 3.54%. Okay. So, reverse engineered the policy. What product did he use? 40-year-old male, 10/90 split, 5K base premium, an L99 policy, which means the base premium does not show up in cash value with this particular product, years 1 and 2. Term rider attached, really stretching it as long as possible, but there's the term cost initially. Let's look at this guy. What do we see? $50K per year going in. Base premium does not show up in cash value. Term rider does not show up in cash value. There's also a PUA rider fee. But there's the breakdown of the product, and it's an L99 product. Let's go back to a screenshot of the 20/80. Let's look at this. First year cash value, 41,738. IRR and net cash value, negative 1652. Here we go. Year 25, internal rate of return, 3.58. Cash value, 1660. So let's go to ours. Net cash value, so this is the 20/80, reverse engineered it. Cash value, 41,738. IRR, negative 16.52%. Year 25, cash value, IRR, everything's matched. Okay. What was the 10/90 product? It was an L99. What do we see here under the product name? It's a 10-pay whole life. It's a 20/80 split, but a different product was used. So I want to touch on something here before we come back to this, is whenever we are looking at any type of split study, transparency and a fair comparison is critical. Now, a 10-pay product credits more cash value up front. I'm going to walk through the limits when we go back to that screenshot there. But as far as trying to make a case, as far as one split being better than the other, to use different companies or different products in that comparison is not fair. Like, I would want to see a true 10-pay to 10-pay. Now, I'm going to go through why he couldn't do that or why anyone can't do that, but a true 20-pay to 20-pay L99, or if you're going to show different products, that's perfectly fine because we show, if you've worked with us, you know this, a million different options to everyone we work with. If you want to see even more, we keep showing you more. But if you're going to use different products to support an argument such as a 20/80's a 2080 split is going to produce a greater internal rate of return than a 1090, you got to disclose that stuff. Someone's going to see through it. Like, you cannot do that. If someone, think of it this way. If I showed you a policy option that was a 2080, which means I can double my compensation because I'm compensated off of the base premium, and I proved that you will have a greater internal rate of return over the long haul. You say, hey, that's great. Steve knows what he's talking about. I'm going to move forward with it. But then you find out after the fact, wait a minute, I just see an option with the same company that produces greater value long term. And it's a 1090, or what's the difference here? It's a lower base premium. Someone else shares with me that it's a 1090 or a minimum premium. Like, what's going on here, Steve? How are you going to feel toward me? You could be upset. Could be the case of you weren't transparent. Why didn't you disclose this? Like, I just want to know up front that everything is fully disclosed. You don't have to tell me every detail, but don't try and hide something, or don't let it be presented in that fashion. So, cannot claim that a stronger IRR exists with a higher base premium split if you're using different products. Like, make it fair. Let's continue on. And with Guardian, as we go back to the spreadsheet, because I'm going to explain that 10-pay product, is Guardian, their sweet spot. If you want a 1090 design, we really touch on this in our All About Guardian video. But if I want to max fund a policy, 10x the base premium, it can technically be a 991 split just about. But if that's what I want to do, really funding it at that brim for, call it 10 years or less, and then stopping altogether, or continuing to pay a reduced amount, whether it's just the base premium, or maybe it's a base premium with a smaller PUA, and your goal is to optimize the internal rate of return, that will do it specific to Guardian. In our last video, we were very specific to MassMutual. All companies have different rules and different things you can do with the products, which are good to be aware of. But going back to this guy, so what I want to touch on here, because this is a 10-pay whole life, which means what? The base premium is due for how long? 10 years. Guardian has a nice feature with their 10-pay, which is after the 10th year, this is the IRR report. Let's actually go down to, or go up to the ledger statement. After the 10th year, Guardian will allow a policyholder to continue to make PUA payments in excess, or continue to make PUA payments into the product, even though a base premium is not due. So there's no base due, but I can continue to make PUA payments. That's very nice. Here's their limitations. So during the first 10 years, while a premium is still attached, Guardian, in respect to PUAs, will not allow one to 10x the base premium. The max you can illustrate on top of it is 5x. Which could very have well been the reason why he used this product for a 2080, trying to optimize a 2080 split. But that's the max you can do. And then after that, what happens as the years pass, so here's our base premium gone after year 10, no longer due. Here is your out-of-pocket, so net premium column, $50K continuing. And you can continue to pay that. This is a 1-year term rider column. Look at this. Once the term burns off, what do you notice happens with your payments? It drops. So when you still have that 1-year term rider attached to a policy, Guardian will allow you to continue to make the payment that you were originally making, the total payment up to the MEC limit, up to the original maximum limit, in this case of 50K. Once the term rider falls off, we remove it, or we started without a term rider. You can continue to add PUAs. However, the maximum allowable limit without underwriting is whatever the base premium was. So the base premium in this example was $10,000. That's why the maximum illustrated number is 10K. Just to provide details, those are questions I would have if I was watching this. But my point here is, as we look at this design, is again, it's not a fair comparison by any means. So what is a method to optimize the internal rate of return with Guardian is something like this, where we mentioned funding for 10 years or less, and then just the minimum. This is just a true 7-pay, funding up to the brim each year, and really maximizing everything within the company's limitations. There's your base premium. We can 10x that in PUAs for a total of 50K, okay? 50,000 per year. What I did here was just juice the internal rate of return with the basic dividend rate. So what do we see? 50 for 7, reduced paid up, $380,000 IRR. Same year 25 mark, 3.69%. What was in the last examples? 3.54 and 3.58%. Okay, now that's with the old product. If we look at the new updated 7702 product, internal rate of return, same thing with the design there, which have greater non-guaranteed performance. Guarantees are not as strong. We've got plenty of videos on that. There's your IRR, 4.11%, so a bit stronger there. My point is we're juicing the internal rate of return. So we're going to look at a comparison, just kind of putting everything side by side, but what we will look at in the comparison as well, and this will be really interesting, is an L99 compared to an L99. And then with the same product and everything truly apples to apples, is a 2080 stronger than a 1099, 1099, is a 2080 truly stronger than a 1090 when things are equal without trying to switch the product or design things differently. If you have enough knowledge on the software, it can be dangerous. And this is not directed toward anyone, as far as anyone in the business or anything like that. So here we go. This was the other agents examples that we have here. And here's really the indicator that we can tell something's off, because without knowing what products are used, which I would say most people probably cannot. So if I'm presented with a case study and I see something like, hey, the 2080 looks like a stronger IRR all the way through, I'm just going to take same company, everything looks the same on the surface, let's move forward with it. But it's not. Different product, different pricing. Like, there you go. The year 5 cash value. If all things are equal, if these are both the same product, there's no way a 2080 is going to have more cash value than a 1090. Because the premium doesn't show up in the cash value in the first year. With a 10 pay, it does. Now, as time passes, here we go. Let's go down to the comparison, and that's exactly what had been proven out. And this actually raises a good point. What a lot of people look at here, they say, all right, like, yeah, I've got a stronger internal rate of return on that example, but I got less money because I was limited based on the product limitations as far as how much money I could pay into it per year. Whereas this guy, I have more. And I've got the Guardian flexibility, which is when I can just add PUAs into the policy at my discretion. But really interesting when I look at that, isn't it? Let's look at this guy. So here's a true comparison. And this is why the 10 pay in my suspicion was pivoted to. Other agent, breaking even between years 5 and 6 with a 1090. Ran everything just juiced for a 2080 split. With a higher base premium, we can now attach a larger term rider and actually pay in $50,000 per year for the full 25 years, which was the whole purpose of the case study that we were presented with. And what do you notice? Now all of a sudden, you've got less money in there because of the limits, but IRRs with a 1090 is stronger, which is the case not just from an illustration standpoint, not just from a guaranteed illustration standpoint, but again, looking at actual performance. When we put policies in force for corporations that have a history with this kind of stuff, this is what they look at. And we did complete our full historical case study. We had about 15 policies we reviewed dating back to 1975, some of them. A lot of stuff here. Here's what I'll wrap up with, which hopefully serves as a valuable point, is when it comes to policy design, do I think that the 1090 is the only way to go and the absolute best option every single time? No. And here's why. It really depends on the company and the product. For example, if someone really likes Guardian and they want the ability to pay into a policy for a long period of time, here's what to be aware of. This is just product knowledge, call it, more than anything else. And a lot of people we work with they don't have to know all of these details, but in having the conversation, we'll go through it. So Guardian, what's their advantage? PUA, flexibility. You can just throw money into PUAs anytime you want. If you really want to juice the internal rate of return, 10 years or less are great as far as a funding period. And attaching a 1-year term insurance rider, that's when we can do it. When that's attached, so when you see that death benefit level, you can 10x the base premium all day long into PUAs, like those 7-pay samples we just showed. However, once that falls off, the maximum PUA you can add, I should add, rephrase, you can illustrate is 3x the base premium. If you set it up right, you can keep paying it. If you don't set it up right, you could be limited to 1x the base premium. But that's something for our agent training business, or you can reach out directly with questions. My point here is if someone said, hey, Steve, I want the ability, Steve or Steve's team, I want the ability to pay in, call it $50,000 per year, not for 25 years, let's say it's 50 years. That's a long time. And I really like Guardian. That's who I want to move forward with because of the flexibility. That's just my comfort. We've had people like that. There's nothing wrong. Like, we're going to show you all the options, make it very transparent. What option should I select, or how would that work? The most optimal design with Guardian specific, with this particular case, would be a 25/75 because having awareness on that 3x PUA limitation, I can continue to pay in $50K per year as long as I cover that $12.5 thousand base premium without having to jump through loopholes, underwriting, any of that stuff. So that's one example, and all companies and products are different there. So it's always important to have awareness there. And a lot of this stuff, if you're in the business, you can get this from rider manuals, companies, product literature, and then really experience is really where I learned the majority of this. But it's just awareness. And if you're a policyholder, just be sure to ask the right questions, look at comparisons. If things look off, it's okay to question it further. Remember that it is your money going into a policy. It is not the agent's. It's good to have awareness in that respect. So I hope that this one provided some transparency. I know this is a deep dive. I like the deep dive. Sometimes I've been told, Steve, it's too deep. So I try and have fun and break it down as much as possible. Anyway, please, if you enjoyed it, hit the like button, subscribe, and I hope this helps. We'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.